Hello and welcome everyone to the fourth video of our series, The Basics of Stock Markets. In the last video, we learned why companies go public and we discussed the three reasons. First, raise fund to meet capex requirement. Second, avoid raising debts. And third, spreading the risk. After that, we learned about the IPO event sequence, that if a company wants to go public, then what are the necessary steps that a company should take to go public. After that, we learned about a few important jargons. To list few: primary market, secondary market, undersubscriptions, oversubscription, and fixed price IPO. So in this video, we learn about the stock market, what actually a stock market is, how the prices in a stock market are calculated, how they are decided, and how they fluctuate. So let's continue with the video. Now, what is a stock market? A stock market is an electronic marketplace where buyers and sellers meet and trade their point of view. So, suppose there is a company XYZ Limited. This is a hypothetical company that we'll be using in our whole video. Now suppose as the stock market opens, this company declares that they have hired a new CEO which can perform better than the previous one and that can make better strategies. So what will be the viewpoint of the market? So should we sell the share of company XYZ or should we buy the share of the company XYZ? So let's proceed and see how this kind of news affects the whole market. Now, after analyzing the news in a deeper manner, we got to know that company had some leadership issues which the company has fixed by changing the CEO of the company. So the market will react positive to this news and the stock price will move up. How it will move up? Because the people tend to buy the shares, and if there is a buy, then that market is known as bullish market. So the stock price will move up. Now what will happen if an organization announced that whole automobile industry will face a huge loss this year? To mention, this XYZ company is an automobile company. So how will the market will react to this? Now you see that XYZ is a company from automobile industry. So if there is a huge loss in the whole industry, then definitely XYZ will also have some loss. So what the people conclude that the price of the stock will go down and people will start selling their share. By this, the company's share will go down rapidly. So now you can understand that how the market participants react to the news and events and their reaction translates to price movements. So that is why the stocks move. If there is any positive news, then people react the news positively and the stock price of the company moves up. If there is a negative news, then the stock price moves down. But this is not always the same. Sometimes there are exceptions where if there is a negative news, the company prices goes up and vice versa. So this is known as the fundamental analysis, where you depend on the news, market news, and some calculations that we will discuss on the later part. But this is the basic, that how the news in a market can change the stock price. So there's a question: what if there is no news about the company? How the market will react to that thing? Or there is no news about the industry, what will happen then? So the companies like Reliance Industries Limited, they have a lot many shareholders and they tend to buy or sell the share in the stock market. So if there is buying and selling, the price will fluctuate, and that depends totally on the mindset of the shareholders. But the price will fluctuate for large companies. What for the unknown companies? The share is not known to many people. So without any news, not many people will visit that share and buy or sell that share. So what will happen? Without any announcement, the share price will not be affected at that scale. Moving ahead, let's learn how the stock gets traded. So as we have taken the example of XYZ Limited, and we want to buy 200 shares of XYZ Limited. Let's see what are the steps. First, we'll log in from our account. So as soon as we log in and place our order, three types of details will be registered. First, the details of the trading account through which we intend to buy the share. Therefore, the identity of us is revealed. Secondly, the price at which we intend to buy the share. And third, the number of shares we intend to buy. So, a ticket is generated containing these three things. So, after the ticket is generated, we buy a stock. Now, let's see what happens after we own a stock. So, after we buy a stock, the share will be there in electronic form, and the share will be transferred in the demat account, that is the dematerialization account. Previously, a hard copy was allotted to you, but now the whole system is electronic and the storage is also electronic, which is in demat account. So now you are part of the company. So you are the shareholder of the company. Now let's see how, in what proportion. So you buy 200 shares and suppose the number of shares allotted is 5 lakhs. So according to the calculation, 200 divided by 5 lakhs, that is equals to 0.0004%. So you own XYZ Limited in the proportion 0.0004%. Now let's quickly learn a new term, that is the holding period. The holding period is defined as the period during which you intend to hold the stock. Suppose you buy a stock today. Now you intend to keep the share, either you do intraday trading, that is you buy the share and sell the share the same day, or you can keep the share forever. So the holding period can vary from few minutes to forever. As we know, the main intention of any trader is to earn profit on daily basis. For this, we can calculate the returns, that how much our money is paying to us, at what percent we are earning the profit. For that, we can calculate the absolute return. So absolute return is defined as the ending period value divided by starting period value minus 1 divided by 100. So suppose your stock value goes from rupees 1000 to rupees 1200. So what is your return? Now after applying the formula, that is 1200 divided by 1000 minus 1 into 100, we got to know that we are earning at a profit of 20%. Now let's see a different way of calculation. That is, for more precision, we'll calculate the compound annual growth rate CAGR instead of absolute return. Now CAGR is defined as V final by V begin raised power 1 by t minus 1. So how CAGR is different from absolute return is that it also take into account the time period. So if we take into account the time period, we got to know that in how much period we have earned how much money. So that will give more better results. So let's continue the calculation. So CAGR for the above values is 1200 by 1000 raised to power 1 by 2 minus 1, that is 9.54%. Now you can see that we have earned this profit in 2 years. So you see the difference. The absolute return was 20% and the CAGR is 9.54%. So in what case we should use CAGR and in what case we should use absolute return? So when calculating for multiple years, we should always use CAGR because it takes into account the time period. And while calculating absolute return, we should calculate it only for 1 year. Suppose we are trading a stock for 1 year or less than 1 year, then we should use absolute return. Moving ahead, let's learn about the types of traders. A trader is a person who spots an opportunity and initiates the trade with an expectation of profitability, exiting the trade at the earliest given opportunity. So there are three types of traders. First is a day trader. What a day trader do? They do intraday trading. That is, they visit, they watch the share for a day and they make the buying and selling decision on the same day. So they are risk averse. Second is scalper. They trade at very large quantities of shares and their holding period is very less. So their intention is to make quick profit. Third is swing trader. A swing trader holds on to his trade for slightly longer time duration and the duration can run into anywhere between few days to weeks. So they typically are more open to taking risk. Now let's learn about the types of investors. So what is an investor? An investor is a person who buys a stock expecting a significant appreciation in the stock. They are willing to wait for the investment to evolve. The typical holding period for an investor usually runs into a few years. So they actually invest for a longer period of time as compared to traders. There are two types of investors. First, the growth investor. The objective here is to identify companies which are expected to grow significantly because of emerging industry and macro trends. So they analyze the macro trends and they invest in such stocks where they expect a huge growth. Second is the value investor. The objective is to identify good companies irrespective of whether they are in growth phase or mature phase, but beaten down significantly due to the short-term market sentiment, thereby making a great value buy. So this is all about the lecture 4 of the basics of stock markets. If you like the video, please like and subscribe the channel, and if you have any tips or you want to learn anything, then you can comment. Thanks and have a good day and stay safe.